Morning. Good morning.
Good morning. So it's very good to have you here. And as I mentioned, today we have two very special guests that I will introduce, and a topic that I think it was missing up to now in our series. We were talking about mobilizing private capital to spark social innovation. And we talked about deep impact vehicles and, for example, how philanthropic impact investment was used to fund social entrepreneurs. And we talk about thematic investing, and we talked about other different issues. But I think today we have also a very interesting webinar. And if I quote, Max posted, and it was a sentence that I liked a lot from LinkedIn when he shared this webinar, that we are going to talk about innovative finance to help humanitarian aid to expand the capital pool and to increase operational efficiency and effectiveness. So we are going to talk, and we're going to try to understand how can we make a humanitarian issues that in the past maybe was even a taboo to think investing in these areas from the private sector. And I think the interesting part is also that we are going to have the vision from Juan from ICRC and the vision of Max from a private investor point of view. And we also be very grounded on their experience. So we will try to learn from some specific examples, but much more general, how we can come up with tools that make humanitarian issues investable. So on that point, you know, at the beginning of the webinar, I share, or I usually talk a little bit about one content. I think what I wanted to mention, in case some of you are not familiar, a little bit what pay for success is. How can private sector actually be the ones putting the upfront funding, financing a service provider? In this case, could be an NGO, or any service provider. This service provider in turn will work on specific and contracted, if you want, outcomes that you want to receive, these positive outcomes that you wanted from the intervention. Then you will have an independent evaluator that will verify that these outcomes were successful as they were promised. And if that happens, then the government will repay, or will actually pay based on that outcome, since it was able to reduce cost to the investors. So you could have private sector that return-seeking private investor involved in a kind of a virtuous cycle, if you wanted, being part of this tool. And we will look at some of the examples. But why I would say that this is, we found this idea quite interesting, is how we could use private capital to service society's needs and to actually bridge the funding gap that you could have between governments and the profit sector. And I think what I found also interesting is that these interventions not only needed to demonstrate impact from the side of the service provider, of the NGO, but also the aggregated cost savings from side of the government. And you could trace it to specific budgets and to specific departments, if you want, from the public sector. So the interesting part here is that from governments, they actually work much better to quantify the cost of social issues, and also nonprofits became much more aware and much better to quantify the benefits of these interventions. No, and I think this in the good cases, when things work very well, and we would see that sometimes the evil is in the execution, and why, when it works and when it doesn't, we'll talk with our speakers. These really form more effective and efficient societies, and at the end, it saves money to taxpayers, because they only pay for interventions that actually move the needle. Now, I think also another interesting thing, and if you think, is that many times this type of solutions of this one had very high transaction costs. So to actually put together all these players or these contracts could be quite costly and risky. So we have seen also philanthropic contributions, foundation, philanthropic impact investors, and philanthropic capital, I would say here, working as a risk reduction mechanism and intervening in And I think we have seen in previous webinars this role sometimes for philanthropic assets to actually buffer the risk return seeking capital and to bring more private capital to scale. So as we have done in previous webinars, I think this webinar here will also focus on this kind of definition we have for impact investment. We have clear the intentionality because we go to the humanitarian sector with very specific type of interventions, but we will see that this type of social impact bonds or other solutions, we have a very clear outcome and measurement of impact. And the idea that the private sector intervening has these expectations of return is also included in the formula. And I think we will talk a lot also about additionality and how collaboration can make these solutions actually work, that without the different assets of the different stakeholders, this would have never happened, and the private capital would not have been able to address these kinds of issues. So just to clear some usual things, you will see at the bottom of the screen or on the top, you will see a Q&A icon. And in that Q&A, please ask any questions that you want to ask the speaker. If you see here in the back, hi Patrick, you can say we have Patrick Reichhardt. He's a research fellow at the Elias Center for Social Innovation, and he's helping us with the questions too. So if he can, he'll be answering your questions, those that are quick, but those that go to the flow, and some of this which I can ask directly to the speaker. So without more introduction, I want to introduce you to Juan Luis Coderque Galligo. He is the head of new financing models at RCRC, at the International Committee of the Red Cross. He has been working for the International Committee of the Red Cross since 1997 in many different positions and had different postings, from the Caucasus to DRC, South Sudan, Cote d'Ivoire, Gaza, Strip, Lebanon, Senegal, Mali, Niger. Now he's in Geneva. So really he has an ample experience on the field of very related to the needs. And he also has worked with and led multicultural teams in conflict areas and post-conflict situations. So since I think in June of 2014, he set up ICRC corporate partnership units in the headquarters in Geneva. And I think ICRC has been one of the, I would say, of the NGOs that were more, international NGOs, more willing to collaborate with corporates and the private sector, when sometimes at the beginning could have been frowned upon and even controversial, and also bringing the focus on the strategic orientation that RCRC can have in this relationship with the corporate sector. So since January of 2010, he's been building on ICRC humanitarian impact bond that we're going to talk today. And Juan leads the ICRC new financing model units, where they're exploring new financing and private and public partnership models for humanitarian action. So welcome, Juan, and it's an honor to have you here. We have also Maximilian Martin. He's the global head of philanthropy at Lombard Odier, also with an extensive career, I would say, in the impact economy, and I'm not using this word lightly. In a moment, you will know why. And I will give a little confidence here. In 2013, I was working more on CSR at the beginning, or 15, 20 years ago, and with social entrepreneurs. And I read an article that to me made a lot of sense, called Making Impact Investment, Making Impact Investable. And it was actually an article from Max. And it made me also think that we didn't need to address only from the corporate side or from the entrepreneurial side, but the financial sector had an important place to play. So he is now the global head of philanthropy and led the ICRC program for humanitarian impact investment. This humanitarian impact bond that we're going to talk a little bit. Again, this webinar is not about the bond, it's about more broader solutions that has been co-sponsored by Lombard Odier. He's really one of the Europe's impact pioneers. He's created the first university course on social entrepreneurship in 2003. He set up Europe's first philanthropic services and impact investment offering at UBS from 2004 and 2009. And he actually is the person that coined this idea of the impact economy, and he has an amazing book that I highly recommend, precisely called Building the Impact Economy, Our Future, Yay or Nay, that develops a comprehensive framework for creating sustainable new businesses. He had many different positions in different institutions. Between some of those, he worked also at McKinsey and the Schwab Foundation, as I mentioned, at UBS, and he founded the Impact Economy in 2011. Another part that I like also is, and I have a bias in these webinars, he's a teacher at heart. He lectures at Harvard, at Geneva University, at St. Gallen, hopefully also collaborates with us here at IMD. So without really more explanation, the webinar today is going to have, like, I would say, 4 blocks. The first one is, what is the point of departure? Where are we? Then we're going to try to learn about the humanitarian impact bond that was co-sponsored by Lombard, Odier, and IRCRC. And then we'll try to see what's in the pipeline, what comes next, and then learnings from this whole experience, and how can we build the market around this. So the idea is precisely how we can bring innovative finance into the humanitarian sector. So let me ask you a first question. Why do we need new ways of financing? Why is this important in the sector? I don't know, Juan, if you want.
I'll chip in first. All right. Okay. Thank you. Maybe just a very, very quick word. I think most people in Switzerland know what the ICRC is. Maybe that's not necessarily the case everywhere. The ICRC, the International Committee of the Red Cross, is that bit of the Red Cross that works in conflict environments, as the countries you mentioned illustrate. We've been around for over 155 years. Perhaps I take the opportunity here to mention that the ICRC and Lombard have been collaborating for since the very beginning of the ICRC, and Max and I have known each other for the past 5 years and working together on a number of issues. Vanina, you said it before, when referring to the collaboration with the corporate sector. I think one of the key issues here is that we cannot do it alone. Yeah, the past 10 years have seen a very, very significant increase in humanitarian need. There is more than the humanitarian sector or government funding for humanitarian aid can actually support. So there's more needs. Public funding is stagnant, and now because of COVID, probably going in the downward direction. But also because we need new ways of working. Yeah, and this is a very, very important point. I perhaps would like to illustrate it with just a story. You mentioned that I worked in Gaza. Yes, I did. That was a long time ago, in 2004, 2006. So it is a while back. But I remember one day we organized a discussion with the tribal leaders of the Gaza Strip, the heads of the families. And I was there, young ICRC delegate, speaking to about 100 elderly local chiefs from Gaza, all dressed up for the occasion. And I started the meeting saying, well, as you know, the ICRC has been working in the Gaza Strip since 1967. And an elderly man stood up and said, "You're wrong, young man. The ICRC saved our family in 1948. The point I'm making here is that humanitarian action tends to be supported by annual budgets, but most of the places where we work, we've been there for 35, 40, 60, 70 years. So we need to add a different way of working that brings together humanitarian development and private actors to focus on longer term ways of impact. We will speak later about, what is the financial, non-financial additionality. So I will not go there right now, but that is at the heart of the conversation. What is the value add? What is it that any idea supported by an innovative financing mechanism brings to the overall conversation? You need a strong value add proposition. Otherwise, it's not going to work. Maybe just very briefly from two separate angles. If when we speak to our government partners, they're looking at innovative finance and new financial models for a series of reasons. Certainly, they want more efficiencies in the system. They want more outcomes-based, approaches. They are very keen, given the needs and the gap, to have private investors, private sector coming into humanitarian settings, or some humanitarian settings for some purposes. We also hear from them that there's a lot of interest in the so-called nexus, meaning in having humanitarian development and private actors work together. And when you speak to development actors, and again, I'm speaking here about the why, is I'm quoting the World Bank. The mission of the World Bank is to end poverty. However, they estimate that by 2030, more than 50% of the poorest of the poor will live in conflict environments. Now it's about 30%. So development actors need to get involved. Yeah. And the question is how. And what we are arguing is that new financial models, innovative finance, is one means for development actors to be more active in humanitarian settings. Just finally, my last point on this, on the why. I also want to be very clear that the traditional way of doing things is and will remain the core of the way an actor like the ICRC operates. Meaning, we get grants from governments, the signatories to the Geneva Conventions, and we make good use of the money and report back. However, the ambition of the ICRC is to target 5% of our income by 2030. So that's about, right now, the ICRC is a 2 billion per year organization. We'll see what it is in 2030. But the target is to reach 5% of annual income through new financial models.
Great, thanks, Juan. We understand that there is this financing gap and this need for long-term, not earmark money, as you were saying, to solve this problem, as what you're saying exactly, developmental and humanitarian crises are getting more and more together. No? So, but Max, is the humanitarian sector investable from a private capital point of view? Why, or is this an interesting space for private investors?
Well, thank you very much, Vanina. I would say the short answer is it can be. The question is, how do we do it? Let me also thank you and Elea and IMD for having us today. I think what you'll see in the discussion today is it is about collaboration and matching different skill sets in order to make progress. That's why we're here together, because we work closely together on a number of projects. To come back to your questions, I mean, Juan said it, if we have 168 million people today needing humanitarian assistance, it's clear, and, a financing gap today in the order of 27 billion in humanitarian only, that we need find new ways of leveraging capital. I would argue, and that's what we're going to unpack in this seminar, that there are three angles. One is, you really do need to incubate these solutions. So I don't know, and it's fantastic to have the global audience here. I don't know if there's someone from Chicago. If you belong to the Chicago school, I have bad news for you, because it's not going to be the neoclassical paradigm where the market will put the light bulb up in the room to light it because it has to be there, because there's demand for it. No, it's more complex than that. It requires intentional action on the incubation side as well. Secondly, at Lombard Odier, we're very interested in seeing how we can partner with humanitarian organizations to make the uninvestable investable. However, it does require some de-risking. Let's be honest, a country like the DRC is not a AAA rated country for a variety of reasons that we'll discuss later. We do need some help. The financial sector needs some help also from the public sector to de-risk. And thirdly, an angle is readiness. readiness among all sorts of organizations to work together and to take measures in order to bring down the transaction costs that you mentioned earlier. So I would say the answer is yes, it can be. I think there are clear pathways, and we're here today to discuss those with you and take questions because we're quite bullish. You know, we've done it together once. We have projects in the pipeline. We think it can be done, but the goal is not to monopolize the learnings. The goal is to share them. So that's my teach at heart element, as you mentioned, Vanina, because we'd like to see this, the game to be changed across the board because it's necessary. The people out there are suffering. It's our job to come up with the solutions that make sense from a vantage point, financial sector and the humanitarian sector.
And I'm very happy to have you both here because the LEA Center, the idea is precisely convening all these different actors. So what can we learn from the humanitarian impact investment program that you have set up? What can you share with us about that experience of the making of and the learnings that arise to start this conversation too?
Absolutely, with pleasure. I'd say I'd go very quickly through it. I mean, it's been covered extensively publicly, so we'll really just go into some of the nuts and bolts so we're on the same page. Well, first of all, what are we trying to achieve here? We're trying to build 3 new physical rehabilitation centers that serve about 5,000 patients a year. And essentially, these are victims of conflict. So they may unfortunately have a missing limb, they have mobility issues, and they need physical rehabilitation support. It could be a wheelchair. It could be, where unfortunately a limb is missing, a prosthesis, where, someone's been impacted by war, for example, or also by diabetes. It could be an orthotic intervention that modifies the neuromuscular functioning of the skeleton. So a pack of services that really helps people in 3 locations, in 3 African countries, the Democratic Republic of the Congo, Nigeria, and Mali, to become active members of society again. And I think, as we know, these countries are complicated. If you're not in good physical health and have no support, it's really challenging. Maybe if we go to the next slide, I'll explain the mechanics behind it. So what was the basic idea? We're here now in one of these examples of outcome funding, contracts for performance. You can call it social impact bond or development impact bond. I have to say, we don't care that much about the wording. We care about the mechanics. And as a regulated financial institution, about being on the right side of the regulation. So a bond that is not a bond shouldn't really be called a bond, but that's a longer discussion. So essentially, what was done here? Well, as Juan pointed out, if you want to build these 3 new centers, you could do it because the ICRC has 140 of them up and running. But initial studies indicated that if you actually develop some new methodologies, for example, electronic patient records, digital resource management, aggregating systematically best practices from the best centers in this pool of existing centers, you might be able to raise the efficiency by 80%. So that's more value for money, and that's important because not enough people are getting served. However, this is a longer term proposition. This, in this case, takes 5 years. And if you work on the basis of annual appeals, it is really necessary to find investors, social investors, impact investors who are willing to take the risk, pre-finance the operation, and then if it works out, get paid for the success. So in this concrete case, with Munich Re as an anchor and several private investors, foundations, family offices coming through the Lombard Odier side, together with the ICRC, we've put together a transaction that has 4 outcome funders who are governments. That's Belgium, the UK, Italy, and Switzerland, of course, and 1 Spanish foundation, La Caixa. They basically, those are all highly reputed countries and entities that they commit, if you achieve what you said you would do, the contract for performance, we will pay you a premium. If you don't achieve it, well, dear investor, we're sorry, you will have to take a haircut. In this case, the maximum drawdown for the investor is 40%. The governments, if it doesn't work out at all, put in 50%, and ICRC kindly, to have skin in the game, puts in 10%. If it works out, and I know, this is something that might potentially be challenging in the mindset, you might get a total return of 34.5%, 7% a year. Sounds like a lot, but I have to venture, you are here in a model where these centers will then be 80% more efficient. So if you were a government funder in the old paradigm to buy the same impact, instead of putting up $26 million, which was the case here, you would have to pay 33.5. So you have a huge saving. And there's a knock-on effect as well, because, you know, this digital resource management system, electronic patient records, of course, over time will be deployed in other ICRC centers as well. We have, however, not tried to capture that in the metrics. The way otherwise the structure is very similar to other social impact bonds. So the investors pre-finance the operation. In this case, it's a loan to ICRC. There's an escrow account being set up into which, you know, upon completion of the project, the governments and the outcome funder pay into. There's an independent verification agent who verifies if these outcomes have been achieved. And there may be an aside, I don't know if we have big four participants joining. You know, I mean, I have to say people know that I like to push the needle. I have to say when we did the process, because everyone loves, I'm not going to mention the names, the big four, funnily enough, there are corporate regulations that don't even allow them to visit the centers they're supposed to audit. That is not viable. So we went for a smaller, more specialized player, but I would argue that you should talk to your leadership to see how you can get involved, because there's, of course, a lot of expertise that should be brought to the table. We thought that in order to make this above board, it's really important to be very, very simplistic almost about the outcome matching. Maybe we could look at that for a second. The next slide. You know, there are a lot of seminars on social impact bonds. We're not doing a deep dive here on this, but what I'd like you to take away from this is that, you know, we've identified what are, say, the high value interventions for the patients, how much effort they require, so they're weighted differently, and who is delivering them. I mean, who are the professionals and operators? Do they have training? Do they not have training? Are they mere bench workers? We normalize that across working hours, because we're talking about 3 different countries here, and therefore get to a formula. This is a formula that is clear, it's measurable, it's auditable. What it does not do is it does not tell you anything about the value add for the patient outside the center, in the sense that they can now work again, for example, or the knock-on effect of having now some innovations that ICRC can use at large. But we intentionally chose not to include that precisely because we wanted to be in the realm of what's transparent and measurable without any equivocation. So that's really the core of this idea. Put something together that's simple, measurable, but that has an innovation knock-on effect for ICRC at large. And if you put it in context, the people at Brookings Institution do a very good job in keeping track of impact bonds. This one is in there as well. The 194 impact bonds currently in their database. This is a slightly different animal. Why? It's a bit longer. The average duration of the impact bonds is 51 months. This one is 60. It is much larger. The average size of impact bonds is 3 million. This one is 26 million. In terms of patients impacted or served, the average in the database is 11,000. Here we have 5,000 a year, but of course it doesn't stop. So it's 5,000 new ones every year and a couple of, unfortunately, repeat clients. So we think that this is actually, and that's one of the reasons why we were very keen on helping ICRC to bring this to market at Lombard Odier. This is a transaction help you build a market, because it's closer to critical size. It's a first step to building this humanitarian impact investing market that you pointed to initially, Vanina.
Great. So, and I think it also has been quite pioneering in the humanitarian sector, not only in the social side that we've seen in impact bonds. But what did you find most exciting, and what were the most challenging points of putting this, if you want, this project together that we can learn from?
You want to go first? Or
yeah, you go first.
Okay, I go first.
Yeah.
So, I mean, what's the most exciting piece? Well, I mean, if you look at it from a long time ago, I was responsible for Africa for a foundation for a year and a half. And I've counted trees in Kilimanjaro. I've visited the Niger Delta because I was the most junior person on staff, and no one else, I was directed, then no one else wanted to go. This is too dangerous. I think, if we are in the field, I have a lot of respect for the people who in very difficult positions try to make ends meet, improve their lives, take care of their families and so on. If we want to really move the state of affairs to a better state, we need to use the market mechanism, because, subsidies, public or private, are simply not enough. So what I personally found exciting, having been involved in this for a while, is that we're now having a shot at scale, at building a really professional solution together with a fantastic organization that has critical mass as well, the ICRC, and thereby hopefully contribute to a new way of working in the humanitarian space that systematically involves private investment where it makes sense, and also enables organizations to really onboard, for example, digitalization in order to become more effective. So it's really an innovation project that uses finance to get to a better state of affairs. The challenges, maybe very quickly, the fundamental challenge is, innovation is always obvious once it's been done, right? But before it's been done, it's not obvious, and a lot of people are against it in any organization. So this is not different in this context. What I would venture here is it's a learning opportunity for everyone involved to how to do things differently. It requires the senior support, but we also have some structural challenges here relating to transaction costs, because putting something like this together requires a lot of work, coordinating the donor governments, building the financial models, etc., etc. I know there are some criticisms about the social impact bond space regarding transaction costs, but I would encourage everyone who espouses that view to go back to data. Data is king in my view. There is a study on the social capital market that suggests that the cost of fundraising is 22 to 43% in philanthropy, and in investment banking it's 2 to 4%. I can tell you we're probably in the 2 to 4% range because a lot of people work pro bono, otherwise it might have been higher, but it's a lot lower than 22 to 43%. So it is efficient if you look at it as an investment in the future, and if you look at the knock-on effect in terms of innovation on a broader scale.
Good. We have 2 questions from the audience about geographies. We have Barnaby asking, how do you choose the topics? I'm sorry if some have moved. Geographies that are more investable than others. What are the criteria for allocation? If you don't mind. Yeah.
I mean, do you want to?
Okay, maybe just one thing, and I'll pass it on to Max, because of course, the response to this question comes from different angles. But one key issue for us is we need to put something on the table that is needs-based, right? We need to start with the problem. What is the problem we are trying to solve? And from a very practical perspective is within our own house, who is interested in being part of this potential solution. So it can be from a very pragmatic point of view, we're going to engage with some of the programs that have the most interest in mobilizing new financing models as part of the solution. Actually, one of the lessons learned with the humanitarian impact bond and other mechanisms is that we, very roughly speaking, we have developed 5 key success factors for any financial mechanism. First is about need. Again, that is the starting point. Are we solving a problem that would not be solved in more traditional and economical ways? Second, do we have the support of those who own the program? Do we have the support of the organization, our own organization? Third, is there a fit with financing models? Fourth, is there a potential market for it? And fifth, do the different players have the capacity to implement the project? So at the time, the physical rehabilitation program was the one that came forward, but also for a series of reasons, because we have a very strong track record in this program. It's not a recent program; it's been around for decades. So this is also a key element in choosing what you want to do. Do you have a track record? And again, the countries we chose are, I come back to my Gaza story, are protracted type of settings, and not necessarily countries that are, in like Syria, where right now it would be a bit more difficult, to consider such a mechanism.
Maybe to quickly complement, I can only really underscore the importance of being need-based. I think the way forward here was to partner with ICRC, because ICRC has the expertise and the global reach on this topic, on serving these populations. And then at the end of the day, looking at specifics, honestly, I would not argue that Kinshasa, Mopti, and Maiduguri are easy geographies. With all due respect, please be my guest. Building a center with decommissioned fighters sitting next to a construction site, a lot of fun. But the advantage is the ICC has the expertise to manage that, to pull it off, build over decades. So our role as co-structures and helping to bring it to market is essentially to make sure that this is evidence-based, that there's a process, and that from private sector perspective, we can provide input to the process that the ICC has put in place to identify where the opportunity is, and then again to de-risk. Again, if this was a purely private investment story, not structured as an impact bond with outcome funding, if someone knows how to do it, I'd love to learn it, but it would be very difficult. However, if you de-risk and have the right people at the table and the expertise of the ICRC in a rational framework, then it's doable, and that's the exciting part. So the allocation has to be needs-based, it has to be data-driven in the sense that there are feasibility studies on the ground, but we also need, and that's why we personally like to work with great organizations, we need to partner with those who have the expertise, because it's really very complicated. You have to have deep expertise to solve things as they come up, because however smart you are, you can't pre-plan everything. COVID being one case.
Yeah, absolutely. So I know you have been working even after the launch of this humanitarian impact program. So what's next? What is in the pipeline?
Okay, thanks. We certainly came to a lot of conclusions and learnings with the humanitarian impact bond, and one learning was that that you need to start with the goal, with the problem you're trying to address, has to be needs-based, and also that impact bonds are a tool in a toolkit. Yeah, we're looking at a spectrum of financial mechanisms that should be mobilized depending again on the problem we are trying to address. Over the past couple of years, we've been working with different partners, certainly with Lombard, Odier, with Munich Re, with some governments, with the World Bank and other development banks. We've been looking at contingent financing, and we come up with a very interesting idea with Munich Re, but we unfortunately didn't find the premium payers. We've been engaging with the World Bank and a whole bunch of others around the famine action mechanism. That is, very much back on the agenda, because among other things, first because it was a very good idea, and also because of COVID, the impact of COVID-19. We've been looking at access to education in Africa, and we're also looking very closely at a major water project in DRC, in Goma. Basically, the main idea is this: have the city lacks the basic water infrastructure. So we want to come up with a project that will. We have a project on the table that should be supported by an innovative financing mechanism that seeks, on the one hand, that's the more traditional bit, to build the infrastructure that doesn't exist. But if you go to the next slide, so that's the bit in blue. Build the infrastructure that doesn't exist. But second, it's also about coming up with a financially sustainable operating model. Now, we cannot do it alone. Yeah, and development actors were not very keen to do it on their own. However, when we put the idea on the table to some development actors and said, "Can we work on this together?" Because we've been in Goma for decades. We've been doing water in Goma for decades. We see the problems and we see the opportunity to think much farther ahead. But this is too big for us. It's too complex for us. Can you help us and come in with your comparative advantage? So particularly when it comes around building the financially sustainable operating model. So we are collaborating with a number of development, corporate, and traditional partners of the ICRC to, in a long-term project at a certain scale, over 30 million Swiss francs. This is still in development, and we are certain for success, from success, but it is on track. We also see that we may have more opportunities in the that is actually a picture of master plan of Goma. We see that we have beyond Goma. We also see that we have more opportunities when it comes to. I mean, there's sense in going for depth. So consider more or additional water projects in the future. We're also looking at energy, particularly the greening of the ICRC. We're looking at different geographies, and we're looking at different partnerships again with development, humanitarian, and private actors. Maybe to underline here again, and I think we'll come back to this in a second, is that there's power in deals. When you put concrete, specific deals on the table, that mobilizes actors and pushes us beyond our usual comfort zone. And we come back and happy to elaborate a little bit more on this because it's absolutely fundamental. Something that Max was saying before is many of organizations say they're interested in delivering innovative finance in more fragile settings, humanitarian settings, but what does it take? Are you organizationally ready to do it? And I think that is a major question. So you have to look at it systematically, but also through specific deals, that get you to walk the talk.
So what is the value proposition for the different actors, if you want also, Max, from the financial side, from this kind, for like the Goma project?
I mean, if you look at it, what is the big difference between physical rehabilitation and water provision? Well, the difference is people pay for water, but they probably don't have the money, unfortunately, to pay for physical rehabilitation services. So what you need to do is you need to find a way to finance the CapEx, I mean, the creation of the new water infrastructure. Mm-hmm. But as far as the operating expenditure is concerned, if you get it right, if you get your price point right, you should be able to make it almost sustainable, or at least a lot more sustainable than in the previous model. And what that means is, from a financing perspective, the investment industry has a role to play here, because we're really about ultimately packaging and pricing risk and bringing investors to the table. But we need to structure this in a way so that we deal with the main risks that, in a sense, would make the transaction otherwise uninvestable, and for that we need help from the public sector and bilateral donors. So if you look at it here, I mean, I'm not giving away a secret if I point you to line 1, political risk. There are other risks, for example, the market risk. Yes, water is a complicated business, but at the same time, I mean, the question was, what's the substitute? Purchasing power is low, but people do pay for water, and there's an interest, of course, in paying for clean water. Cholera, for example, is an issue in the Congolese Switzerland, unfortunately, where the region of Goma is also called. So a better product certainly has a role to play. The counterparty is a publicly owned water management company. Of course, there are some questions as to how do you help them to adopt, I would say, the most recent or adaptable management techniques in order to run this at a more professional scale. Then, of course, if you invest in a location where you're not, I mean, you're in a frontier country, let's be honest, people are not going to pay you in dollars for the water. You have issues around this, such as currency fluctuations and so on. However, all of these risks can be mitigated through intelligent action by a variety of players if they come together around it. And I think one of the important points here that we would like to leave you with is, it's not really, we shouldn't put the financial instrument before the problem solving. We're trying to solve a very specific problem here. How do you get clean water to hundreds of thousands of people in Goma? And Goma is, the population is exploding there, essentially. That's needed. We do not have what I would call an innovation in the box solution here, as with the physical rehabilitation centers, because ICRC had been doing that since 1979, very successful. It was an optimization within a framework. We're here talking about something that is more a new, in a sense, transitioning an activity to a financial business model-based initiative. So we need really probably much more in a risk capital logic here, but you cannot take equity, or it doesn't make sense to take equity in a public company in Eastern Congo. So there's certain things you need to bear in mind. But again, I'm sorry, I'm biased, but the wonderful thing about financial markets is that they're typically solutions. If you want to apply them, you can think about guarantees, for example. You can think about initially underwriting some of the capital expense to make it happen from bilateral donor perspective. So there are solutions that render this viable. At the end of the day, we're probably talking about phase one, $30 million plus need to be mobilized. But it's not just about the money. And I realize, the title of the seminar is Topping Up Investment. It's more than topping up investment. It's really structuring the solutions so that they become investable with partners. And, at Lombard, we're delighted to contribute to that project. But of course, others are invited to do that too. These are ambitious, game-changing approaches that require multiple players to be involved.
And I think this is a common view that we have seen in other webinars, that we do have many different financial instruments in the financial sector. And we know we have all these needs in the humanitarian sector, and putting together the collaboration and combining the different assets that the different players have to de-risk in and really make these projects come alive is the key, And it's already 50, so time flies when we're having fun. So I want to go to a little bit to the generalize the learnings. How can we assess if an institution is ready to get involved in these innovative financial collaborations? How do we build the market? Because I think we have a lot of different people in our audience that may want to get involved in this type of comprehensive collaborations, and at the same time, it might look like, okay, this is impossible. How do you do it?
Okay, thank you. Two super important questions. I will start with the following. When it comes to the, what do organizations need to do to be, to be able to be ready to actually function in this space? Well, I would say, first of all, participate in deals. Yeah, because deals are going to test your boundaries. That's number one. Second, we've been doing a major piece of work with the Boston Consulting Group, supported by the Swiss government, by ECHO, by the World Economic Forum, ODI, the World Bank, around the organizational readiness of the main players, whether it be humanitarian, development, corporates, different types of institutions, to actually deliver innovative finance in more protracted or fragile settings. And we've been looking at it through 5 perspectives. Okay, I'll just be brief on this, but I think it's important to name them. First is about mandate. Does your organization, have a mandate to operate in this space, or are you giving yourself, the mandate internally to do this? Do you have the organizational support? One thing is to have the support of the leadership. Another thing is to have the support within the different levels and areas and expertise, geographic of the organization. 3, do you have the systems and processes? Again, humanitarian actors, tend to budget on a year-per-year basis, and here, GOMA, we are planning, 5-6 years out. That represents a number of challenges. So, are we ready? What do we need to do? To give one example. Then it's also about resourcing. Are you putting your money where your mouth is? Do you have? Are you building up a team? Are you supporting different métier experts so that they can contribute? Are you mobilizing seed money to explore and experiment? So resourcing is a key element as well. And finally, it's around capacity to implement. And again, this can also be a major challenge. The point here is that most of organizations, will be at different stages of development around these 5 buckets or dimensions. And if they want to move forward, then they're going to have to keep moving along the a maturity curve. And then maybe just very briefly, I'll pass it on to Max. When it comes to building the market, so I will repeat myself, put deals on the table. Again, that helps move everything. But in addition to that, it's about engaging bilaterally, but it's also about engaging in initiatives like the humanitarian investing initiative we launched last year in Davos 2019 with the World Bank, with the WEF, with with the government of the Netherlands and the impact investment branch of Credit Suisse. Lombard Odier is also part of the equation, as are governments, foundations, etc. And this is done at the highest levels, because you have to do both things in parallel. You have to put deals on the table, and you have to build the market.
Maybe just to quickly compliment, I agree with everything that was said, which is not surprising because we work with each other. I would definitely encourage you to have a look at this playbook produced by BCG. Why? You won't find all the answers, but you'll find good frameworks. And my main advice would be honesty and self-reflection. Let's be really clear where you stand from your organizational point of view, what you bring to the table, what you have appetite for. And there's one, we have this up as a slide as well, the traffic light perspective. Some of us have done projects in Joburg, for example, where, I have to say, at a certain point in the day, in the night, you do burn a traffic light. It was not very safe otherwise. So even there, if you move forward on certain projects, your leadership may want you to go very quickly, which is okay once in a while, but you do need to look at the fundamental readiness. Otherwise, you can produce one solution, but it won't be repeatable. So it's all about building that. And again, I think, Juan, you said at the beginning, with your experience in Palestine, history matters. I think as professionals in a variety of industries, we need to ask ourselves, on which side of history did we want to contribute? Because one thing's for sure, even though we have a lot of discussion about the Sustainable Development Goals, if you look at the data, if you look at the financing gap, if you look at the implications of COVID, we're not on track currently. And we need to really work together from our vantage points, bring our financial management and humanitarian expertise together to come with new solutions that punch above the weight and show the path forward. And I think it's a responsibility for all of us and every one of you in the seminar as well to think through, what can you do from your vantage point? We're not here to tell you what you should do. We're just encouraging you to say, let's do something that makes sense, be rational about it, be realistic, and use these tools. And I would obviously argue the market mechanism has a role to play in finding the solutions.
Excellent. Let me ask you a question. There is one of the participants, and now somehow the question moved, but ask about COVID. How has COVID affected the fundraising or even this type of deals? Can there be a silver lining? Are we realizing maybe after the post-COVID needs to be a collaborative world, or really is private money drying up?
Yeah. Okay. Maybe I'll just give it put a number of elements on the table. It is clear that COVID is having, first of all, a huge impact in terms of needs. Yeah. Needs are increasing because of COVID. Yeah, and it goes beyond health. It goes without saying. It's also about the socioeconomic well-being of people in many places, all through the world, including in fragile environments. So needs are going up, and it's clear that overseas development assistance is going to slow down. So that's the second. That is the second point. A third point is that I started the discussion mentioning a number of reasons why governments are also interested in innovative finance, new finance models. So I think there's going to be even more pressure around that. More efficiencies, more sharing the burden, having new actors coming into the space, more focus on outcomes. So what we and maybe the fourth point is that we have seen over the past few weeks and months, of course, strong reaction of support for our work, also around the impact of COVID in the places where we work. So thank you to our traditional donors for supporting us. We're also seeing some less traditional donors, like some big public development bank. Saying, let's work on a financial mechanism to address, some of the impact, long-term impact of COVID. So there's challenges, major challenges. The situation for the population is worse. ODA will be affected, but there are also opportunities going forward.
I have to say, I fully agree with that. I think what the good news in all of that is, at least from our vantage point, investors' hunger for purpose has not diminished. So that is positive, something we can work with. However, it does require intelligent intermediation because at the same time, the pendulum is now swinging back from private initiative to public or government initiative. In the mainstream of the economy, we're seeing already this creating some distortions. If you just look at the fiscal stimulus, for example, and how it's being deployed. I think, if we look at what we can do better by working with each other, by really giving ourselves permission to be innovative in coming up with new formulas to crowd in private capital to come up with better solutions, and also use data, more to advantage to target, to have a better targeting of social programs, then I think, in fact, with hindsight, COVID could have been, can have been in a sense, the turning point where the humanitarian sector, in a sense, started to resource a very serious modernization effort. Because I think what we see now is it's already happening at level of different organizations, but not to the same extent. It is now becoming an imperative. And again, I think it's about learning, sharing learnings, collaboration. And we hope that, by supporting the small way, the work of the ICRC, we can help being a catalyst in getting to a better state of affairs that uses private capital in intelligent ways to drive development outcomes.
Time is going crazy, and I have lots of questions that I'll probably send to you later on that we couldn't address. But one that is very quick, because I think sometimes could be the elephant in the room. And do you know, Sonia is asking, to your knowledge, what is the default rate on social impact bonds, and what happens in countries where the government cannot pay? Will you consider teaming up with a corporate for developing a project in an area like this?
Well, I mean, the reality is, if you look again at the data, of these 194 impact bonds, 183 are social impact bonds in OECD countries for the most part. 11 only take place in developing countries, and including the one that we just mentioned, but they're not financed by developing countries. I would argue that Italy, Belgium, the UK, and Switzerland can pay their commitments. So I don't think it is a solvency issue as part of the outcome funding. That's not the case. There could be an operational issue in terms of delaying execution. If we look at the one that we have currently up and running, we're now basically through the construction phase of these new centers and about to open them. There may be some delays, but at the same time, we've built in a year into the model where basically the model is being tested, the operational model, and the data on efficiency is gathered only afterwards. So I would argue, you will not have solvency issues. If you need to review how your impact bond was structured, given the inability to operate, the best thing is to really talk to your investors. Let's not forget, this high conditionality capital, what it really wanted to do is drive better outcomes. If you now have an act of God, force majeure, that obviates what you can do for 6 or 9 months, you need to talk to your partners and see how you come up with solutions.
Great. So time is up, but I would like a last sentence to close up. What would you be to say to our audience, or as a takeaway from this really interesting and collaborative, I would say, also webinar?
Okay, two or 3 points super briefly. One is that this is a long-term effort. You have to test, explore, learn, correct, but also you need to focus on certain areas of expertise going forward. That's the first point. Second, organizational readiness around those 5 dimensions we mentioned before is absolutely fundamental. And third, yes, this is complicated. It is complex, but to abound on something Max was saying before, when you look at the ICRC doesn't work on the basis of the SDGs. We work on the basis of humanitarian law, and we've been doing it, more than a century before the SDGs were around. But the point is that it's not that the SDGs are not on target. In addition to that, when you look at the more fragile settings, then they're really going backwards. So the world cannot ignore that. We need to find new approaches to solve those massive needs, and collaboration across sectors, enabled by financial mechanisms, can be one part of the solution.
Right. Thank you, Juan.
I think basically COVID is calling into question a lot of cherished assumptions. The stimulus has now, sort of bid up the prices of shares. Fine, that's good for investors. But we need to look more fundamentally at, how we can solve these underlying problems in the humanitarian space and development space at large, because I think it's really a fantasy to think that otherwise, even I assume most people here participating are in a privileged environment, that you will enjoy your privileged environment 10 or 20 years from now. I mean, we do need to address inequalities. We do need to find ways to bring people into the system to make it work for everyone. And again, what excites me is to see that investors want to play a role in that. So financial institutions should, of course, provide solutions in public markets in the space of sustainable finance. But I think, you should also use some of your expertise to support organizations such as the ICRC and others in other fields to come up with deep innovation that really moves the needle on what private capital can do to help achieve development outcomes in a way that is probably de-risked, but then also creates financial returns, because otherwise you will not get more capital into the space. So I would say it's the time to step up. We're at a crossroads. I think the engagement in your seminar, the collaborations and discussions we had in preparing for it demonstrate that we can rise to the challenge together in the spirit of collaboration. I can only underline again how delighted we are to collaborate with you, Juan, with ICRC, and also with Lea, because I think that's a new model going forward. We need to challenge ourselves, come up with new solutions, but I would argue, yes, we can do it, and we should.
So thank you so much. And I want to finish up quoting Pierre Valérian. It's actually a person of our audience. He wrote a comment in French that I will poorly translate in English. But he said, thank you very much for the conversation and the passion that you're transmitting and your ideas. And people like you, and I think all of us in the audience too, is what we need in the world right now. So thank you for everything. And I think this is the idea also of the Lea Center for Social Innovation, is to bring this spirit of collaboration and to bring, again, these new solutions that are not cookie cutter, one size fits all, as you mentioned, but that build on creativity, on passion, and especially to the drive for impact. So thank you so much, Juan and Max, and count me in any of the projects, and the same to you. Feel free to contact me on LinkedIn or at the Lea Center, and I hope I see you all next Wednesday for the next webinar. Thanks so much, everybody.
Thank you.
Thank you very much. It's been a pleasure. All the best.
Thank you so much.
Okay. Thank you, everybody.
Thanks so much. Gracias.
Thanks. Gracias a todos.